Welcome back. My name is Arya. I don't waste your time, so let's get straight into it. I had you guys vote on the next video that I made roughly 10 days ago, and so the votes have been cast. It is how to calculate intrinsic value in making buying decisions, and that is exactly the video we're going to be making today. As you guys know, in every single one of my videos, I include this spreadsheet that I made, and it looks more complicated than it is, but it simply takes the current valuation of the company in column K over here, and it divides that by the expected growth rate that we expect for that business. This is it. This is the big secret. This is exactly how I calculate the intrinsic value of every single company. As you can see, I've color coded it for you guys. So in green is companies which I think are presenting themselves as pretty good value for the amount of growth that you're getting, right? Based on the price to free cash flow valuation of that company. And then in the red, you have companies where I think for the amount of growth that you're getting with the underlying company, it's not particularly attractive as it stands currently. And then you got in the middle, you got your yellows. Now, this way and this method of analyzing businesses fails to look at the qualitative aspect of things, which if you guys have watched my videos, you would know that that is something that I strongly consider, like for example, the various moats of the business, the network effects, the scale economies, the brand of the company, all that type of stuff. So the things that don't show up on paper don't show up in this spreadsheet, right? I think that's pretty obvious, but this way of looking at valuation, this way of valuing companies and trying to calculate whether or not an investment is attractive at the current price that it's trading at, it completely misses the qualitative aspect of things, right? That's where your judgment needs to come into play and look into factors such as like Microsoft being able to grow 15% free cash flow on a way longer runway than, for example, something like Ulta Beauty, right? We just had Starbucks earnings where all of a sudden we were under the impression that, okay, EPS is going to grow at 15 to 20%. And then now they've just guided for like 1% growth on a year over year basis, right? So these type of things need to come into play when you're considering the various investments that you're able to make and whether or not the moat of the company is able to live up to the growth, right? If Microsoft, which in my opinion probably has the widest moat of them all, I think that company, you need to put a premium on that valuation because of how durable and how predictable and how sustainable that moat is going to be on a going basis. I'm going to do a quick analogy for you guys, and I don't intend for this video to be like a big 40-minute woo-ha and all this other stuff, right? So over here, we're going to have time. This here's going to be time. And for example, let's have like 5 years, 10 years, 15 years, right? Then I'm going to do two companies here. Yeah, company one. So company one, let's just say it's something like a retailer, like an Ulta Beauty, right? The high degree of confidence, you could probably say, okay, you know what, Ulta Beauty or Starbucks or whatever, they're going to keep opening these stores. It's a business that is going to consistently grow for at least the next couple of years. With a high degree of confidence, you're able to say that this business is going to roughly grow at, let's just say 15% over the next 5 years, right? But past that, you really don't know what's going to happen. Is Sephora going to start taking market share from Ulta Beauty? Or is McDonald's going to start taking market share from Starbucks, right? All these different things you don't really know past the 3 to 5, maybe even 7 year mark. You could perhaps analyze different secular trends, such as more people being willing to buy from quick service restaurants and all that type of stuff. But on a more general note, it's a complete question mark whether or not Ulta Beauty's growth rate in 10 years from now is going to be even similar to what it is today. If you looked back maybe 2, 3 years, or maybe even more, maybe 5 years ago, and looked at Ulta Beauty and the growth rate was 20 something percent for the free cash flow, you can't really sit there and say that today it would be growing at the same clip because it isn't, right? Why? Because it's more of a mature company now and it's a little bit more slow growing. They're not opening stores as fast, right? All these various things you can't really predict. But let's just take, for example, Microsoft, right? Microsoft is an extremely predictable company. You know that it's roughly growing at 15% today, and odds are in 10 years from now, it's going to grow at 15% again. And maybe it slows down over time because, I don't know, cloud gets more mature, but odds are it doesn't slow down much, right? It has massive secular tailwinds behind it. And on top of that, they have massive pricing power whereby they're able to increase prices on their office suite and all that type of stuff over time. And people are happy to pay it. How do we know that? Because it's happened over the past 30 years. For the past 30 years, Microsoft keeps increasing prices on Windows, on their 365 suite, on all the different products that Microsoft provides on their B2B services, right? They're, I think, the second or third biggest customer relationship management company as well. All these different B2B services, office suite, all that type of stuff. They're able to keep increasing the prices on this, and people are more than happy to pay it because of the efficiency that it unlocks for their employees and all that type of stuff. So my question to you is, if a business only grows at 15%, then in actuality, we find out that in 5 years' time, turns out the growth, or sorry, in 10 years' time, the growth actually slows down to a measly 5%. And then eventually, by the 15-year mark, they're just growing at like GDP plus a little bit. So 3%, whatever, right? Which company would you have rather bought? Because sure, you have this company that's maybe even, you know what, maybe it's even growing at like 20% in the first 5 years, right? Sure, it's growing faster to start off, but as time progresses on, with a high degree of confidence, can you sit here and say that that company is going to be compounding their growth, their free cash flow on a longer time frame? How long is the runway of growth for company A like Alta Beauty compared to company B like Microsoft? Microsoft with their cloud and their 365 suite and all that type of stuff, odds are the runway of growth for that type of company way longer than something like a retailer like an Alta Beauty or even perhaps like Chipotle, right? Chipotle is an incredible company. I personally love Chipotle. I eat at Chipotle multiple times a week sometimes. But odds are that a restaurant like that doesn't have as durable of a runway of growth as something like a Microsoft. Now, you guys might be sitting there thinking, okay, you know what, Aria, great. Sure, Microsoft has a really long runway of growth, whatever the case is. Okay, incredible company, but I'm still not willing to pay up for that valuation, because if you pay up for that valuation and it gets halved over the next 5 years, it's like negative 7% returns or something ridiculous, right? I hear you. I have a solution. I think the part where there's a real mispricing of assets would be something like Salesforce, where as it stands currently, for the amount of growth that Salesforce is able to provide, you're getting it at bargain prices, right? Salesforce, I estimate personally, it's expected to grow at roughly 18%. Their free cash flows are expected to grow at roughly 18% over the next, give it 3 to 5 years. And then they have a natural secular tailwind behind them and possibly maybe like 10% past that, right? As it stands currently, with a high degree of confidence, I can say it's going to grow at 18%. That being said, you could go buy as many shares as you possibly want, 30 times cash flow multiple, which means that's a 1.67 times growth multiple, right? It's a work in progress, but that's what I'm calling growth multiple. Column L, right? Multiple. But as you can see, it's not like cheap stocks or cheap valuation. It necessarily has to be like a bad company, right? Or Evolution Gaming. I talk about this company like almost every video at this point. But Evolution Gaming, in my opinion, has a very sustainable moat. You don't have to go dumpster diving for. I'm not going to call Alta a dumpster company, but you don't have to go down. You don't have to sacrifice quality for valuation and growth multiple and all that type of stuff. There are companies, and there has been mispricings whereby companies that are of extreme quality, they go down in price, and you're able to buy into them at seemingly good growth multiples compared to how much they've historically grown or how much they're expected to grow. Another kind of cool exercise that I do personally is, once I come up with my assumptions and I'm like, you know what, FICO is extremely expensive, or ServiceNow is an extremely expensive company, I go onto this website, and I'm not affiliated with them, not sponsored, nothing like that, Finance Charts. The only website that I've found that gives you historical valuation data completely free, and it doesn't spam like 100 ads in front of your face. But I'm going to leave the link in the description and all that type of stuff. You could go onto this website, click the valuation, and gives you all types of different options for price to cash flow, free cash flow yield, PE, EV to EBITDA, all that type of stuff, right? And you could sort by up to even 20 years of historical data, and it shows literally everything, right? So this is, I think, probably like a weekly or every 2 weeks view of MasterCard's price to free cash flow valuation. And as you can see, MasterCard is a company that at its lowest point was trading at a 24 times multiple, which is probably just slightly above the market multiple. But yeah, as you can see, it's a company that, especially in the past like 5 years, has held its very high valuation, right? The cheapest they got was roughly a 31 times multiple. And if you scroll down, it shows MasterCard's current valuation, which is 38 times cash flow. This is normal cash flow, by the way, not adjusted for stock-based compensation. But it takes the current valuation as it stands currently and compares it to the last 12 months, or it compares it to the average of the 3 years, the 5, the 10, the 15 year. So as you can see, you might look on the surface, or even using my method, you might look on the surface, MasterCard, it's a little bit on the more expensive side. It's 30 whatever times cash flow. This is forward, by the way. You guys here are probably using trailing. with MasterCard. But you might look on surface and be like, you know what, 40 times cash flow is really expensive. I'd rather buy something like Ulta Beauty at 15 times cash flow. I think it's more margin of safety, right? And would be right because the amount of growth you're getting, Ulta's probably a pretty good proposition. What you have to understand is the market places a massive premium on MasterCard's business model just because of how durable, predictable, and the moat is just incredible and all that type of stuff. And that could be seen through the average historical valuation. MasterCard has historically had an incredibly high valuation, especially when comparing to the S&P 500. I think, pull up my calculator here. Go. So the current S&P 500 free cash flow yield is roughly 3.8%. So as an expression of, like as a multiple, that's roughly a 26 times multiple, right? Which means MasterCard at 38 times multiple, that would be a roughly 46% premium to the S&P 500. You have to ask yourself, is the quality of MasterCard's business 46% better than the average S&P 500? I'd be inclined to say yes, because MasterCard is just a world-class company, completely one of a kind, benefits from massive scale economies, network effects, all the usual stuff, right? And again, seeing the average price to free cash flow valuation chart would be evidence of that, right? If you see that MasterCard on average trades at around the valuation that it trades at today, that would probably hint you towards the situation where you would look at it and be like, oh, that's odd, would be something like Microsoft, right? Look at Microsoft, the 20-year average is significantly lower than the price to free cash flow that it trades at today. Microsoft trades at over here we have a 10-year high. Over here we have a 15-year high. Microsoft trades at a 20-year high in terms of cash flow. Microsoft valuation in the past 20 years has never been higher, right? So when you look at something like this, you're like, okay, is Microsoft really that much more predictable than it was maybe 5 years ago? Like they still had Azure, they still had the 365 suite and all that type of stuff. Okay, sure, like the ChatGPT stuff is new and all that type of stuff, but is it really that much better of a company? So you might look at the valuation chart here and look at it and be like, oh, you know what, that's a little bit odd. Maybe perhaps ran up a lot in terms of valuation. That's why the stock has done incredible, right? And the stock has done incredibly well. Look, past 5 years, it's up 210%. It's massively beating the S&P 500. Even on a trailing 1 year basis, 31% compared to S&P's like probably like 20%. It's still beating the market. It's an incredible company, and I'm not discounting that. I'm simply pointing to the facts. The historical valuation of Microsoft is significantly higher than it has been the past 10, 5, however long, right? So again, this is kind of how I deal with valuation and how I figure out intrinsic value. From there, I make my buying decision based off qualitative factor. That being said, I just wanted to say most of you guys aren't subscribed, and I know every single YouTuber says this, but it seriously comes at no cost to you, and I would sincerely appreciate it if you hit the subscribe button. You could always go back on it if you don't like the videos, but I plan on putting out high quality videos just like this. So please go ahead, hit the subscribe button. Again, it comes at no cost to you. That being said, thank you very much for watching. Have a great day.